Hello, good morning to all and happy Friday. This is Kelvin here again, the Senior Market Analyst of OANDA Asia Pacific. Very good morning. Welcome to today's Daily Dose of Market Insights. Today will be Friday, the 22nd of March 2024. So before we start our Daily Dose of Market Insights, let's take a look at the disclaimer first as usual. All right. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses could exceed deposits. This presentation is not an offer or solicitation to buy or sell, no financial advice for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so as usual, let's have a quick recap of what has taken shape yesterday in terms of significant performance across the broad-based cross asset classes, and as well as the events and data that drives this significant intraday performance. All right, so what happened yesterday was actually two events, monetary policy events that is related to UK Bank of England monetary policy and as well as Switzerland SMB. All right, so what we could see because of these two central banks, we call it monetary policy outcome as well as guidance, it actually erased off the earlier dollar weakness exposed FOMC. So if you recall back on yesterday, Thursday, we see the dollar weakness coming back into the market. We actually lead on to a risk on behavior in the risk asset. That means, i.e., we see a significant rally in the market leaders, which is the major benchmark US stock indices, where the S&P 500 and the Dow Jones Industrial Average continue to break fresh all-time high. But what happened yesterday was a reversal. So what we could see over here is that we see dollar strength coming back into the picture, and from a technical perspective, the dollar index has managed to surpass back again the 200-day moving average, which actually right now reduce the probability of further dollar weakness, at least in the short term. All right, so what is the main forces or main factors that actually drive this short-term dollar strength back into the market yesterday? Is actually, like I mentioned earlier at the start, is due to Bank of England and SMB, and most importantly, SMB is the Switzerland bank of the Switzerland central bank. They actually cut interest rate ahead of the US Federal Reserve. That means, i.e., ahead of other dovish central banks, which are actually guiding market participants that they will cut in the summer months of this year, like the ECB, the Fed for sure, and as well as Little Bank of England that share with you. Okay, so now let's take a look at. I want to share with you my screen over here. Okay, 1 second. Let me pull up the chart. Okay. All right, so that you guys could see this news flow. Okay, give me a minute. I think the screen is kind of hang at the wall. Okay, yeah, I think you guys could able to see the expanded one. Okay, good, excellent. Okay, what is this going on? Okay, 1 second. Sorry about that, because I think the thing seems to be hanging right now. Okay, it's not what I want to share with you all. It's the other one. Yeah, my apologies. Because it's got hang. Yeah, this is the one I want to share with you all guys. All right, so actually they surprised it because market participants expecting the Central Bank of Switzerland, which is SNB in short, to actually be in line with the Fed and ECB, and to unlike the first cut in the summer months of this year, which is in June. So what they did over here is that they actually cut the interest rate by 25 basis point ahead of the ECB and the Fed. And most importantly, what we could see that the dollar strength starts to come back across the board, driven by the Swiss franc weakness. And the president of the SMB Central Bank, President Thomas Jordan, he actually said that the fight against inflation over the 2.5 years has been effective. All right, that means, i.e., the previous tightened monetary policy. And also, I do reckon that over here is that a couple of months ago, that President Thomas Jordan, pardon me, he also be pretty much negative about the ongoing Swiss franc strength against the European currency, that's making the Switzerland export less competitive. All right, so as you know that Switzerland exports itself is one of the primary driver of Switzerland economic growth. So I reckon because of this reason, because the Euro Swiss is getting weak in the last couple of months or so, in the last 6 months, so that's also drive SMB to actually ignite interest rate cuts ahead of the Fed and as well as ECB. All right, so that's from the Switzerland point of view. And on top of that, as you know, that Bank of England previously, they were one of the few central banks that are pretty much staunch on their so-called risk of external inflationary pressure coming back into the UK economy. So they are actually in the last few meetings, even some of the central bankers not central bankers, some of the officials in Bank of England actually favor of hiking rates instead of cutting. So there's actually some of the camp that is breaking away from the dovish camp. Actually, 2 or 3 of them, they're actually looking to actually hike rates instead in 2024. So there's not sign like the not like a unified we call it a view within the Bank of England itself. But however, the last few hawks in Bank of England yesterday has managed to throw in the towel and starts to support for a potential rate cut in June instead. So that's also see the sterling dollar tumbled as well. All right, so that's why because these two central banks, we call it guidance and monetary policy outcome that drive the dollar strength back into the picture yesterday. Okay, so what you see over here, let me share with you. This Bank of England. Okay, so Bank of England over here, even the governor say is that UK is on the way winning the inflation fight. Okay, so because of this expectation, market now participants has started to price in the first interest rate cut to come much earlier for in UK in the month of June, very similar to Fed. Previously, they're actually looking at somewhere around in August. All right, so now because of the much more dovish vibe that is coming out from Bank of England, yeah, despite the fact that yesterday they chose to actually hold the interest rates as expected, but the guidance itself is much more dovish than the previous meeting. Okay, so that's what you see over here. If you could look at, it actually drive the dollar strength coming back in the picture as well. Okay, so if you look at this, okay, so if you were to share with you all, this is the 5-day rolling performance. Yeah, okay, so what we could see over here is that the dollar strength starts to shoot back up among all the major currency, with the one leading for sure will be the against the Switzerland, the dollar Swiss, and it also drag up the dollar yen as well. So let us share with dollar yen. Very interestingly, the dollar yen still refused to break above the 151.95 major resistance level. All right, why this level is important, as you know that later I'll share with you in the technical chart, you're able to see it's a very clear major resistance level. Okay, then upcoming the pack over here will be the dollar against the sterling pound. All right, where we start to see the dollar strengthening against the sterling pound and dragging up against the rest of the currency as well. So what you could see over here is that yesterday this short move by dollar strength in the Swiss franc, and thereafter that much more dovish vibes that's being portrayed by Bank of England, all this has dragged up the dollar strength. So if you look at the this is the key data I'll share with you all. So if you look at the technical right now on the dollar index, okay, so you look at the dollar, this is the dollar index over here. Okay, so now the dollar index, right, has started to surpass back above the 20, the 50, and the 200-day moving average. So previously in ex-post FOMC, which is the US Federal Reserve meeting, the dollar actually sold off because of a much more, we call it a US Federal Reserve that is still pretty much committed in their interest rate cut cycle. But right now, because the rest of other central bankers, the SMB and the BOE, they are much more dovish than the Fed instead. That's what they portray in the market. So let's see a big jump in the dollar index that actually engulf the previous bearish candlestick. Okay, so in technical analysis, we could say that this is a outside bar or a bearish engulfing, a bullish engulfing, pardon me. And what most interesting over here is it surpassed the 103.70 level resistance level, which is the 200-day, the 20-day, and the 50-day moving average. So the next resistance level to watch for sure will be the swing high area of 13th of February this year at 104.85 mark. Okay, so in the short term, what we could see over here is that there could be some more probability of short-term dollar strength coming back into the market, all right, based on the strength of the dollar index that we're seeing it right now. And with the dollar index, the dollar strength coming back to the market, it actually lead to a bit of risk-off behavior in the US market as well. So despite the fact that the US market, even though they started at a very strong session yesterday, this is the S&P 500, what we could see is that after the middle part of the US session, where dollar strength getting more and more obvious, the S&P actually sold off and ended trading at the day low. All right, at the day low, despite the fact that they actually have a positive gain, but the positive gain was actually pretty much reduced or significantly reduced after the second half of the session. Yes, the SPX ended positive 0.32%, but however, the earlier gains were wrapped up significantly, as you could see my intraday chart over here on the S&P 500. So very similar for the Nasdaq 100 as well. Right, so the earlier intraday gain was during the first half of the US session before around 12:30 a.m. Singapore time. Then thereafter, the intraday gain was also wrap up and it managed to close at the low during the close at the close of the US session yesterday. Still managed to get a gain of 0.44%, but the earlier gains of close to 1% has been reversed, more or less reversed out by the close of the US session by looking at this steep fall. And if you look at the Dow Jones Industrial Average, that one, the Dow Jones was the outperformer, pretty much stable, okay, yesterday at having outperformed the S&P and the Nasdaq 100 at positive 0.68%. And you look at the intraday chart, yeah, it hit a peak at 12:30 a.m. Singapore time, okay, but thereafter it didn't show off as much as the Nasdaq and as well as the S&P, okay, but managed to actually oh gosh, let me go back. Okay, it's a bit lagging for now. Okay. Okay, I'm not sure what's going on. My hopefully, okay, yeah, you're up here, all right. Okay, I'm not sure what is moving. Okay, so what I want to share with you all is okay, why is it slowing down? Yeah, so what we could see, this is the sell-off in the S&P throughout the later part of the US session, and if you look at the Nasdaq as well, it actually sold off as well. Okay, right, it sold off as well, but the Dow Jones Industrial Average, okay, I think it's a bit slower. My internet over here, that's why it's lagging. Yeah. Okay, so the Dow Jones Industrial Average, instead of selling off in the later part of the US session, it actually remains sideways. Okay, so but later I'll show you the technical chart of the Dow Jones, which is the US Wall Street 30 over here. There's some form of short-term hesitant by the bulls as well. All right, so then thereafter, with the dollar strength coming back into the picture, we see gold also pretty much lackluster uh, as well. Didn't actually have a positive follow through after yesterday's push up to fresh all-time high at the close to the 2210 level. Okay, so what other important data that has taken shape earlier this morning is up from Japan. Okay, so Japan at 7:30 a.m. Singapore time, they actually released their nationwide inflation data. So this is not the Tokyo one. The Tokyo inflation data will be released 2 weeks in advance before the nationwide one. So the nationwide one for the month of February, if you look at the core inflation rate, right, actually managed to tick upwards again, 2.8% from 2%. So if you look at the trend of the Japan core inflation rate over here, all right, at this point. So what you could see that previously it was actually decelerating in January. Then after a while, this month it managed to spike up to 2.8%. So accelerating, posting the highest reading since October last year. So overall, if you look at the trend of the core inflation rate in Japan, it's still indicating to us that they are still in the healthy upward trajectory. So if you look at the last 10 year, right? It is the last 10-year data. So they are actually still inching upwards above that 2% mark, where this is the target of the Bank of Japan's, we call it Bank of Japan 2% target. So there are more signs, right, in Japan, pointing to us in Japan, stating that we are more or less has been a increase in inflationary pressure in Japan, and also very, very low odds for the Japanese economy to slip back into a deflationary environment. And this also could be expressed by the yield, the JGB yield. So if you look at the JGB yield right now over here, okay, let me save this. Let me open up the chart of the JGB yield for you. Okay, so why this JGB is important? Because it also have an impact on the dollar yen rate. Okay, hopefully the internet connection is good, but it seems to be slowing down at this point in time. Okay, let me double check. Okay, so far it's connecting well. Yeah, it's connecting well. Okay, good. Okay, yep. Okay, so if you look at the JGB, this is the 10-year JGB yield. So 10-year JGB going to trend relatively smoothly from the low of 15th of Jan this year, going to inch upwards by sloping a series of higher low, all right, but still below the so-called that 1% level. So previously this was a reference level where BOJ kind of detected it, but now it's no longer even become a reference level as well, because they totally kind of officially scrapped that yield curve control program. But however, they still put in a little footnote in their monetary policy statement saying that they will nimbly buy up JGB bonds without specifying any amount. I mean, there's no clear amount. I mean, they could increase it. They mentioned in their footnote, if the 10-year, if the long-term JGB yield, which is the 10-year, implied by the 10-year, starts to move up in a very steep rate on the upside. Okay, so this is what they mentioned in the footnote. But what's interesting over here is that the 2-year JGB yield, which is more tied towards the short-term interest rate policy of Bank of Japan. Don't forget, right now, Bank of Japan now is no longer targeting the 10-year JGB yield anymore. I mean, officially, they are right now pointing towards normalization, their short-term policy rate. So the short-term policy rate, which is the overnight rate, now become the official benchmark interest rate, where they actually scrap up the negativity and start to push up to positive territory to actually allow it to trade between 0% to positive 0.1%. And the one that is pretty much tying closely to this short-term policy rate is the 2-year JGB yield. So you look at the 2-year JGB yield has started to spike up very, very strongly, and even today's price action right now at 0.204% managed to clear above the previous high of 11 of March at 0.2%. Okay, slightly above it, 0.24%. So, but for sure, the trajectory is actually pointing upwards. And if you look at this spread, right, the JGB spread between the US and the JGB spread, right, especially the 2-year Treasury versus the 2-year JGB, it continue to actually inch downwards. All right, going to inch downwards over here. So what you could see over here is that the US Treasury yield premium on the 2-year is getting lesser versus the 2-year JGB. So very similarly on the 10-year yield as well. Okay, so if you look at the 10-year yield, okay, oh gosh, what the hell is it? Okay, let me open up. Okay, it refused to break above this key medium-term descending trendline resistance. All right, so this is the spread between the longer term, because the longer term tenure, 10-year US Treasury yield versus 10-year JGB yield. So similar as well, the yield premium, the US Treasury yield premium has started to string against the JGB. So overall, what it means that over here is that it's not so much getting more attractive for Japanese investors or pension funds, or call it, or any as Japanese asset management, to actually transfer or put away that transfer their funds park in US Treasury to get that yield premium. So this yield premium is getting lesser due to the fact of that differential between the JGB and the US Treasury. So that actually, if that going to actually play down, that could actually cap dollar strength against the Japanese yen. All right, so from a fundamental perspective, okay, so that's the reason why I want to share with you the importance of the ongoing upward sloping JGB yield that both is occurring right now on the 10-year, which has a lesser magnitude, but the one that is steepening much more steeply will be the 2-year JGB yield. All right. Okay, something to look out for from a fundamental perspective that could actually slow down the dollar strength against the Japanese yen. All right. Okay, now with that, okay, that is the key economic data that has taken shape yesterday, which has impacted the broad-based asset classes, and as well as today's early Asia session economic data. Okay, so with that, now let us straight away jump straight to the short-term technical outlook of the various broad-based asset classes that I would like to share with you all. Okay, so right now, let us start with the FX space first. So given the volatility in the FX market yesterday, all right, so now let's start with the euro dollar. Okay, so this is the euro dollar. So for sure, right, the euro dollar, whatever strength in the euro dollar that took shape exposed FOMC has been taken out. Okay, so let me expand my screen so that you guys could see. Yeah. Okay, so whatever gains has already been reduced. All right, so what we could see right now is that price action is rather fast and furious on the downside, and right now it's testing that 1.084 uh support level, which is key, which is the 200-day moving average. Okay, so with that, right, the first resistance to watch will be very surely the 20-day moving average that's been taken down yesterday, which is now acting as a resistance at slightly above it, which is 1.0870. So I will use that any potential bounce here, as long as it didn't surpass the 1.090 level, this level here. So this level is where the price action didn't actually manage to survive. After hitting it, it bounced slightly. Then thereafter, there's a steep sell-off in the US session. Okay, so for sure, this is a key uh, level to actually prevent any bulls from pushing up. All right, so as long as 1.090 short-term pivotal resistance holds for today in any potential bounce, I will flip to a short-term bearish bias on the euro dollar. After a breakdown of 1.0840, it will expose the 1.08 next short-term support level, which is the minor swing low of 28th of February to 1st of March. Below 1.08 level exposes the next near-term support at 1.0760. Okay, 1.076 level. Okay, so that's for the euro dollar, flipping to a bearish bias. Only an hourly close back above 1.0890 will elevate or negate this bullish tone to see a slight recovery to retest yesterday's European session high at 1.094 level. 1.094 above 1.094 exposes this minor top resistance level, which is at 1.0970. Sterling dollar. So sterling dollar is the weakest. It actually broke. It's much weaker than the euro dollar. Why? Because the euro dollar right now still managed to hold at the this Tuesday. Okay, this week lower area, which is this level here, 1.084. Okay, but however, the sterling pound managed to actually print a lower low this week. For this week. Okay, so these are fresh low so far that we see for this week. So what we could see over here is that it also broke below the former minor trend line support level from 14th of February, now turns into a pullback resistance at 1.2690. Okay, we also confluence with the 50-day moving average as well. So with that, right, I do not want to use this level here as my short-term pivotal resistance level. Is a bit tight, so I would rather use the 1.2730. So after a breakdown of this level here, this is where you see that after the broke of this level, where it actually accelerated on the downside. Okay, so for sure, this is an important technical level because this is the kind of trigger level that saw that steep sell off in the sterling dollar on the hourly chart. So what we could do over here is I will use 1.2730 as my short-term pivotal resistance level. All right, any potential bounce that didn't surpass 1.2730, I will flip to a short-term bearish bias on the sterling dollar. Next support level to watch will be the 126 figure level, which is also confluence with the 200-day moving average. A break below 126 figure level exposes the next near-term support level at 1.2540, which is the minor swing low of 14th of February and 16th of February. Only an hourly close above 1.2730 will negate this bullish tone to see a kind of a choppy minor recovery to test this minor swing high area of 12th of March and 14th of March at 1.2820 level. Right now, Asia Pacific currency. Okay, let us start with the, okay, where is it? Okay, where is my Aussie dollar? Okay, let me close this chart first. Let me save it. I think I accidentally closed the chart. Okay, this is the one. Okay, let me reopen the tab. Okay, I think I accidentally closed the tab. Okay, okay, Aussie dollar. Okay, so this is Aussie dollar. So Aussie dollar also broke down below the 50-day, the broke down below the 50, the 20, and the 200-day moving average, which is the previously as support at this 65-60 level. Okay, so I'll be using this 65-60 level to actually flip to a bearish bias. So I got to expect this strong push down. So that bounce up that we wants to that we have initially to retest 66.50 has been invalidated. So right now we will see another round of choppy downside movement again to retest the bottom of this range area here at 5th March and 28th of February. So first support level to watch at will be 65.10, followed by the range support of 64.80. All right, so we'll be flipping to a bearish bias as long as any bounce managed to hold at the 65.60 short-term pivotal resistance. Only an hourly close above 65.60 will invalidate the short-term bearish bias to see another round of choppy recovery to retest 66.30/66.50, which is the minor swing high area of 8th of March and yesterday's European session high. Okay, so now the one that is mixed over here is dollar yen. Okay, so if you look at dollar yen over here right now, is actually trying to test again this major upper limit of the major resistance level at 151.95. So what's 151.95? It tested one time, two time, three time, and every time it tests, thereafter there's actually a significant sell off in the dollar. So the one that lead to the most significant sell out in terms of magnitude is will be the actual BOJ intervention on 21st of October, where the Ministry of Finance instructed BOJ to sell dollar by yen. So previously in the month of 31st of October and 30th of November last year, they actually came in, but they verbally, so they actually step up their verbal intervention instead of actual uh, selling of the dollar. So they actually intervene it verbally, but the tone of their verbal intervention is pretty much more pronounced. So what we could see over here is that it's now coming very close to this level again. So far, there's actually one noise that's being made up today, early this morning, by the finance minister Suzuki. There's a verbal intervention, but this verbal, okay, where the hell is it? Okay, so this verbal intervention is not so much of not so forceful, because he said that he won't commit on at the forex level. All right, so but he just mentioned that important forex rates to move to stable, reflecting fundamentals, and watching forex move with high sense of urgency. Okay, so this is the usual subdued verbal intervention. All right, so for now, that's why at the moment in time, even though we see the dollar strength coming back into the other pair, that means which I shared with you earlier, or the euro, the sterling, and the Aussie, but it seems to be right now subdued again at the 51.95 due to this subtle, not so forceful verbal intervention out from this finance minister in Japan. So if you look at the hourly chart for now, okay, this is the hourly chart. So hourly chart, there's a bit of what I call hesitance by the speculator to push up above 51.95, and if you start to see the hourly RSI starts to inch downwards as well, shaping this kind of whatever bearish divergence, because we see similar high so far, but the RSI starts to slope downwards. So all in all, right, given the rest of the rest of the major currency showing dollar strength, so instead of dollar weakness, so very hard for me to actually have that bearish stance on the dollar yen. So I'll rather have a neutral stance in the short term between this major resistance at 51.95 and yesterday's low, which is at 50.30. Okay, so neutral between these two range for today. Unless we see an hourly close below 50.30, then we could see much more pronounced weakness potentially on the dollar yen to expose the next near term support level at 149.50/1, followed by 148.90, which is so confluence with the 20-day and the 50-day moving average, also acting as a support at this similarly at these two level as well. Right, so that's pretty much sum up for the FX market. So what we could see of the FX market over here, there is pretty much of a dollar weakness, dollar strength, no, pardon me, dollar strength coming into play. But that dollar strength right now seems to be actually taking a pause on the dollar, on the yen side of the story, because of that fear of that intervention at the major resistance at the 151.95 level. So with this interesting stalling at the 151.95 level, what we could see over here, we could see the cross pair of the yen cross pair. So this is the yen cross pair. That means yen will be the variable currency. So you see the other major currency is actually weakening against the yen, which is sloping downwards. So this is the 1 month cross over here, and due to the fact that because of that rising 2-year JGB yield as well, and also the yield premium between the US Treasury yield and the 2-year JGB, means the 2-year Treasury yield versus the 2-year JGB yield has also started to reduce. This is the 1 month rolling performance over here. Okay, let me hide that. Okay, it's actually inching downwards right now. So if you look at the last 5 day, it's also start to see the yen strength coming back into the rest of the other currency. So right now this is called the yen crosses. So with that, the weakest for sure will be the Swiss yen. All right, so why Swiss yen? Because of the SMB surprise interest rate cut yesterday to weaken the Swiss franc. All right, so if you look at, so what we could see over here is that there could be some potential yen crosses. We call it potential kind of a technical interesting technical configuration. So let me very quickly, right before we jump into the short-term technical outlook on other instrument, I'll share with you because on the yen crosses, so if you look at the yen crosses over here, the Swiss yen. So you see the Swiss yen on the daily chart remains subdued. All right, below the this 173 key major resistance, which is the bearish ascending wedge, and right now is actually showing signs of weakness to retest the 200-day moving average at 166.55, and also the daily RSI going to flash out this bearish momentum play by this daily RSI that's being kept by this parallel resistance, all right, since the high of 16th of November. And if you look at the hourly chart, this is where it start to play out. All right, it's now breaking, for sure it breaking below that 20-day moving average. So I'll be using the 20-day moving average as a short-term pivotal resistance on the Swiss yen 169.50. As long as this level didn't surpass, right, potentially it could actually see further weakness. First near-term support level to watch will be at 167.90, which is this minor trendline ascending support that I drew from 11th of March. A breakdown below this level exposes 167.10, followed by 166.55. So what's 166.55 is the 200-day moving average, all right, over here. Okay, on the daily chart. Okay, 166.55. Okay, 166.55. Yeah, very close to this, and as well as the lower boundary of this bearish ascending wedge configuration. Okay, you could see over here, I dropped the low of 3rd of October. All right, so only an hourly close above this 169.50 will invalidate this bearish tone on the Swiss yen to see a very choppy squeeze off movement to retest the European session high yesterday at 170.70. All right, so that's for the FX market. So very quickly back to the major stock indices. So as we know that, given the fact that the dollar strength is coming back into the market, so this has started to see weakness across the board for the Asia indices. Hong Kong Hang Seng Index breaking below that 1648 short-term pivotal support level that we have for us to see that continuation of that corrective, we call it counter trend rebound scenario within its medium term downtrend that is still intact, and major downtrend is still intact, because the Hong Kong 33 going to trade below the 200-day moving average. So with the clear breakdown of the 1648, we will now turn into a bearish bias instead for the short term, and also it start to break below the 20-day moving average, and as well breaking below the minor ascending channel support that I drew from the low of 22nd of January. All right, so what we could see over here, obviously right now there could be some form of more pronounced weakness coming back into the Hong Kong 33, at least in the short term basis. So next support level to watch will be at 16,135, followed by 15,730. As long as 16,960 short-term pivotal resistance is not surpassed to the upside. Okay, so this is the Asia session high yesterday. All right, so flipping to a bearish bias below 16,960. An hourly close above 16,960 will negate this bearish tone to see a potential retest of their 2-week high area at 17,230. Above it exposes the key 200-day moving average, acting as a resistance at 17,570. Then what we have over here is the Nikkei 225. Still remember the Nikkei 225 yesterday, we flipped to a bearish bias because of a potential setback, and the setback actually took shape and reintegrate back. There was actually a bit of whipsaw at the 41K short-term pivotal resistance we highlighted yesterday. So there's a bit of excess. So we highlighted the excess at 51,175. So that's European session high. Why we will still maintain that short-term bearish bias? Because of the RSI has started to turn bearish as well. So this RSI right now very clearly is broken down below this parallel ascending trend line support that is in place since 11 of March, and very clearly is broken down below it and trading below the 50 level mark as well. So indicating to us that yesterday's upside momentum has started to abate and potentially increase the odds of a short-term pullback scenario. So still maintaining that short-term pullback scenario or short-term corrective setback scenario on the Japan 225/Nikkei 225, as long as 41,175 excess short-term pivotal resistance holds. First support level to watch 40,050. A breakdown below it exposes 39,990 slash 39,840. So if you do the FIBO retracement, okay, of this last minor up move up, it confluence with the 38% and 50% FIBO retracement level, okay, very closely, and as well as the upward sloping 20-day moving average is also coming close to this support zone as well. Only an hourly close above 41,175 will invalidate this short-term minor corrective setback pullback scenario to see the continuation of this impulsive up move to expose the next near-term resistance zone at 41,475 slash 41,660, followed by 41,800. All right, then with that in mind over here, the German 30 still remains rather strong, but in terms of the conviction right now, it's still holding above the support level. Why? Because it's still trading above the ascending trend line support that I drew from the low of 14th of February. So yesterday it almost hit the first resistance at 18,340, and thereafter it just traded sideways throughout the US session. All right, so with that, I'll be still maintaining that short-term bullish bias outlook, but given the fact of the dollar strength coming back, to picture, my conviction will be much lesser for today, but I still got to respect it. Why? Because it's still holding above the short-term pivotal support that we have, and also above this ascending trend line support. So using 18,050 as my short-term pivotal support level, still maintain that short-term bullish bias on the German 30. First resistance for sure 18,340, followed by 18,500 FIBO extension of 0.675, which is the potential fifth wave target of this ongoing minor uptrend move from 14th of February, which is also confluence with the upper limit of the minor ascending channel. Only hourly close below 18,050 will negate this bullish tone to kickstart a much more deeper minor corrective pullback scenario, very similar to one that we see in the Nikkei 225 right now or the Japan 225 right now, to expose the next near-term support zone at 17,900 slash 17,790, which will confluence with the upward sloping 20-day moving average. Right, US indices. So US indices right now we start to see a bit of choppy movement. So yesterday it hit the first support resistance level at 18,470, and if you look at currently right now, the RSI, this is the Nasdaq 100, has really broken down below this parallel key ascending trend line support as well. So with that, right, potentially we could see a bit of setback weakness on an intraday basis below 18,470. So I'll use 18,470 as my short-term pivotal resistance level for this potential corrective setback scenario to play out. First support level to watch will be the 20-day moving average, also acting as a support level at 18,110, which is the former minor swing high area of 20th of March and 19th of March. Below 18,110 will potentially expose the next support level at 17,940 slash 17,820, which is also confluence with the minor swing low area of 6th of March and 15th of March. Only hourly close back above 18,470 will negate this potential minor corrective pullback scenario on the Nasdaq 100 to see the continuation of this impulsive up move to expose the next near-term resistance level at 18,620, which is at the 76.4% FIBO extension that I drew from here, and also the upper limit of this potential minor bearish ascending wedge configuration that is in play since 22nd of February low. All right, this line, this gray line that I draw over here. Okay, now US Wall Street 30. So US Wall Street 30, very similar price action as well. The hourly RSI, okay, and starts to flash that bearish divergence by shaping similar high, whilst the price action on the US Wall Street 30 start to shape higher high. So with that, right, it's all coming very close to the first resistance that we highlighted, the second resistance that we highlighted, 39,990 short-term pivotal resistance yesterday. So with that, that could also be signs of a potential minor corrective pullback or setback on the US Wall Street 30, given the fact that this 39,990 also confluence with a Fibo extension cluster level, right, that you could see on my screen over here. So using 39,990 short-term pivotal resistance, as long as this level didn't surpass, the US Wall Street 30 could potentially undergo a short-term minor corrective pullback or setback. First resistance level, first support level to watch, 39,640. A breakdown below this level potentially exposes the former breakout level, now turns into a pullback support level at 39,270. All right. Only hourly close above 39,090 will invalidate the short-term minor corrective pullback scenario to see the continuation of the impulsive up move to expose the next intermediate resistance at 40,240, followed by 40,500. All right, so that's not pretty sum up for the major US stock indices. A bit of hesitance by their momentum deterioration in the short term, upside momentum deterioration in the short term, with only the one that is still holding strongly, very clearly in the uptrend without any clear signs of a momentum deterioration is the German 30 index. All right, so now WTI crude oil. Okay, so WTI crude oil continue to hold above their 20-day moving average support level. Okay, and what we could see over here is that yes, yesterday that pullback continued to extend over here, but what we could see is that the hourly RSI has started to shape that bullish divergence. All right, over here, there's a bullish divergence by the hourly RSI. So indicating to us that some signs of downside momentum have started to ease off from yesterday's sell-off. So where it actually paused, right? It paused actually at this minor range resistance previously that is in place since 4th of March, 7th of March, then now turns into a pullback support level. Yesterday it came down, tested and managed to bounce. And right now during Asia session, it is attempt to do a test again. So with that, right, I'll be using this level here, which is 8060. Okay, 8060 as my short-term pivot level. So this 8060 will be my short-term pivotal support level to maintain this short-term, we call it potential minor recovery scenario on the West Texas oil. First resistance to watch for sure will be yesterday's European session high at 82.20. Above it exposes the this week swing high area, or this week swing high area at 83.20. Okay, only an hourly close below 80.60 will invalidate this minor recovery scenario to see the extension of this corrective decline, minor corrective multi-day corrective decline to retest the 200-day moving average, and as well as the 50-day moving average also acting as a support at 78.80, followed by 77.35. All right, lastly, spot gold. Okay, so for spot gold over here, where is the spot gold? Okay, spot gold. So for spot gold, right, yesterday what we could see over here is it fails to actually test the 2030 resistance level, and it starts to shape that sell offer at this point in time. So with that, right, the RSI also kind of get lackluster, hold below the 50 level, but hasn't hit the oversold region yet. So it could actually shape a bit of minor push down to retest the minor key range support area that managed to help since 18th of March, which is this Monday, this week low area. Okay, so I'll be using this 2192 as a short-term pivotal resistance for today on spot gold XAU/USD for that potential minor we call it setback to play out to retest this minor we call it range support zone area at 2160/2146 level. Okay, a breakdown below 2146 level will see the extension of this minor corrective decline to expose the next near-term support level at 2125. We also confluence with the upward sloping 20-day moving average. Only hourly close back above 2192 will invalidate this minor short-term we call it corrective setback or pullback scenario to retest the minor range support, to see the continuation of the impulsive up move for spot gold, with the first resistance for sure to come in at 2230 level. All right, a breakout above 2230 exposes 2260. All right, so and one of the reasons why we actually flip to a much more bearish bias on spot gold is due to the fact of that dollar strength coming back into the other major pair, which is the against the euro, against the sterling, and as well against the Aussie. So with that, that pretty much sum up for the short-term technical outlook. So before we go, right, let's take a look at the calendar. What are the key data to look out for today? So other key data to look out for today is during the European session at 3 p.m. will be retail sales, UK retail sales, followed by there's one economic business sentiment, climate business sentiment data, which is up from Germany, info business climate sentiment data for the month of March at 5 p.m. Singapore time. And thereafter, we have a pretty much quiet US session. All right, so there's no key data out from the US session thereafter. Okay, so with that, do have a great day ahead, and I wish you a great weekend, excellent weekend as well, and we shall speak again on next Monday. Thank you.